In simple words, a loan is money borrowed from a friend, bank, or financial institution in exchange for repayment of the principal and interest at a later date. Learn about the many sorts of loans and weigh the benefits and drawbacks of each. What is a loan? You are most likely in the minority if you have never taken out a loan to buy something. Loans can be beneficial, but they can also lead to financial difficulties. Understanding whether loans are an appropriate answer for your position is one of the keys to financial success. If you can't afford to repay a loan in the time allotted, you shouldn't take one out. Let's look at what a loan is and some of the most frequent ways to get money. A loan is when you borrow money from a friend, a bank, or another financial organization in exchange for repayment of the principal plus interest in the future. The main is the amount you borrowed, while the interest is the fee you paid to get the loan. Because lenders are taking a chance that you may default on the loan, they must compensate for this risk by collecting a fee known as interest. Secured and unsecured loans are the most common types of loans. A secured loan is one in which the borrower pledges an item, such as a car, boat, or house, as security. The lender takes custody of the asset if the borrower defaults or fails to repay the debt. Unsecured loans are favored, but they are less popular. If the borrower fails to repay the unsecured loan, the lender has no legal authority to demand repayment. Loans come in a variety of shapes and sizes. Personal loans. These loans are available from practically every bank. The good news is that you usually have complete freedom over how you spend your money. You may take a vacation or purchase any things you want. Personal loans are often unsecured and quite simple to obtain provided you have a good credit history. The disadvantage is that they are usually for little amounts, usually not exceeding $5,000, and the interest rates are greater than those offered by secured loans. Advances in cash. Cash advances from your credit card company or other payday loan companies are an alternative if you are in a pinch and need money immediately. These loans are simple to obtain, but the interest rates can be exceedingly expensive. They are normally reserved for little sums of money, such as $1,000 or less. These loans should only be explored if there are no other options for obtaining funds. Loans for students. These are excellent options for funding a college degree. Stafford and Perkins loans are the most frequent types of loans. The interest rates are low, and you normally don't have to pay back the loans while enrolled full-time in college. The disadvantage is that these loans can easily exceed $100,000 over the course of 4, 6, or 8 years, leaving fresh graduates with significant obligations as they begin their new employment. Loans for mortgages. This is most certainly the largest loan you will ever take out, so if you want to buy your first home or some other type of real estate, this is probably the best option. The house or property you are purchasing serves as collateral for these loans. Mortgages enable people to get into homes that would otherwise take years to save for. If you don't make your payments on time, the bank or lender can take your house or property back. They're usually organized in 10, 15, or 30-year terms, and the interest you pay is tax deductible and relatively modest when compared to other types of loans. Home equity loans and credit lines. These sorts of loans allow homeowners to borrow against the equity in their home. The difference between the appraised value of your house and the amount you still owe on your mortgage is the equity or loan amount. These loans can be used for home improvements, home additions, or debt restructuring. The interest rate is frequently tax deductible, and it is also relatively inexpensive when compared to other types of loans. Loans for small businesses. People who want to establish a business frequently get these loans from their local banks. They do necessitate a bit more effort than usual, and they frequently necessitate the creation of a business plan to demonstrate the viability of your endeavor. Because these are frequently secured loans, you will be required to put up some personal assets as collateral in the event that the firm fails. Benefits of taking out a loan. Why people used to take out a loan. One of the most common methods of business funding is to take out a loan. Borrowing loans can be done for a variety of purposes, including financing a business or paying for school expenses. In a circumstance where you don't have enough money, your only option is to take out a loan. You can take out a loan for either short-term or long-term financial demands. You have the option of taking out a loan from a bank, friends, family, or relatives. Take a look at some of the advantages of taking out a loan. Growth. Every individual requires finances in order to expand their business. You'll need extra money to develop your firm if you want to be a successful entrepreneur. Obtaining a loan can enable you to make an additional move to expand your company. You can budget well and plan how you will reach your objectives thanks to the availability of funds. If you expand your firm, you will be able to apply for larger loans based on your income. Flexibility. Flexible loans are available at all times. Before the loan is issued, the interest rates, the length of the loan, and the amount can all be negotiated. Even after the loan has been approved, you can make changes. You can make plans for repaying the loan and, if necessary, request changes. When you take out a loan, you have complete control over the entire amount. What you do with it is entirely up to you. No one has the authority to tell you how to invest your money. Rates of interest. Some banks have lower interest rates so that low-income earners can get a loan. Many borrowers are enticed by low interest rates. Borrowers can submit collateral as a type of security in the event that you default on your payments. The bank will be able to seize the collateral. Customers are attracted to lower interest rates. Conclusion. The above advantages of borrowing a loan will increase your confidence in obtaining a loan. If you repay your loan on time, you will build a good credit history and be eligible for a larger loan. Borrowing a loan is critical. It comes in handy when you don't have any cash on hand and will come in handy whenever you're in a jam. Every business will require outside capital at some point in order to expand. There are numerous ways for small businesses and startups to raise capital. Bank loans are one of these methods, and in the right circumstances, they can benefit a business both short and long term. In this post, we will look at the benefits and drawbacks of bank loans for small businesses. In simple words, let's have a look at advantages and disadvantages of bank loans. Advantages of a bank loan. Interest rates at a low. Bank loans typically have the lowest interest rates. The interest rates you pay will be lower than those of other types of high-interest loans, such as venture capital. Bank loans have significantly lower interest rates than credit cards or overdrafts. Flexibility. When you get a bank loan, the bank will not give you a set of rules that govern how you spend the money. While venture capitalists and angel investors may limit what you can do with the money, bank loans may allow you to spend it as you see fit. You can use the funds from a bank loan to purchase new equipment, enter a new market, or carry out a new marketing strategy. Control must be maintained. A bank loan does not require you to give up equity. Typically, venture capitalists and angel investors expect you to give them equity or a stake in your company. However, this is only true if you make your bank payments on time. Disadvantages of a bank loan. Profitability is required. While venture capitalists and angel investors are willing to take risks in order to invest in companies that have not yet proven profitable, banks will not. To be eligible, your business must be consistently profitable, which rules out the vast majority of startups. Complicated. Obtaining a bank loan takes a significant amount of time. You'll have to fill out a lot of paperwork, and the terms of your loan will be complicated. The process will also not be quick. It can take several months to qualify for and obtain capital from a bank. Bank loans are among the most difficult to obtain when compared to other types of financing. Collateral. Banks will require some form of collateral regardless of your profitability or credit score. Banks must protect themselves in the event that you are unable to make your payments. Hope you understand what is a loan. Definition, types, advantages, and disadvantages. Have a nice day.